Welcome back. Corporate real estate 2018 seeing major developments within this sector. Announcements made by companies like Apple, Google, Amazon, all investing in new technology campuses. My next guest runs a really unique real estate investment trust. He's the company of the chairman of the S&P 500 company Alexandria Real Estate Equities, an urban office REIT focusing on life science and technology campuses. Joining me right now is Alexandria Real Estate Executive Chairman Joel Marcus. Joel, it's great to see you again.
A pleasure.
Thanks
Happy
so much
New
for
Year,
joining
Maria.
us. Happy New Year to you. You have such a unique business because what we're seeing in terms of the growth and expansion, these new campuses, is exactly your sweet spot, where you have been developing for so many years now.
They are. We focused on the really irreplaceable clusters where the technology and life science companies want to be, and along transit lines and in major urban locations, which really enable them to attract and retain great talent.
So we're waiting to see, what some of these campuses look like. I mean, Google, Apple, Amazon have big dreams, and they're going to probably be really beautiful campuses. How's business right now? Characterize what you're seeing.
Well, it's frankly as good as it gets. It isn't necessarily thought of in the macro markets, but supply is very constrained. Demand has been very strong. In fact, we deliver here our pipeline for 2019, where we actually deliver completed projects, about 2.5 million square feet, almost 90% leased. And in the Bay Area, we'll deliver Merck's West Coast research headquarters, first time they've been on the West Coast. Verily, which is a subsidiary of Alphabet, as you know, their life science subsidiary. Pinterest, I'm sorry, not Pinterest, but Facebook and Uber. We're building 1 million square feet for Uber in Mission Bay, right actually next to the Warriors' new stadium. So a very exciting time and place to be.
Yes.
We did deliver Pinterest just a couple months ago.
Yeah, and this is one of those companies. Pinterest is going to probably go public.
They are.
In 2018. We just did a segment on all the IPOs that are coming to market. And again, this is in your sweet spot. Do things change when the company becomes public? Could you expect even more spending in terms of expansion on real estate?
Well, we certainly hope so. And I think the big area in the technology world today, and they can't recruit enough people, is data privacy. So we know that Facebook, Uber, Pinterest, Stripe, our tenants have large requirements for data privacy talent out there today, which is, I think, fueling growth in space as well.
Yeah, and I love the idea that the company is doing a lot of biopharma, healthcare industries. You come to this conference every year that we see you. This morning we had news that Eli Lilly is acquiring Loxo Oncology for $8 billion. And then last week we saw Bristol Myers Squibb announce its acquisition of Celgene. What happens when you see more deal flow? I mean, do things consolidate when you see that, or do you think that's a sign of market strength?
Yeah, there are really two sides to so-called M&A, merger and acquisition. One is where the larger company goes after the pipeline, the product pipeline of the company, which I think is a Celgene, and I think you'll see consolidation and savings in the New Jersey campus area, which is unfortunate, I think, for New Jersey. But if you look at Celgene bought Juno, a CAR-T cancer therapy company, a couple of years ago. That's in Seattle. We actually have their corporate headquarters. There, the M&A, Celgene buying Juno was primarily for people, unique products, and a technology platform, so no consolidation there.
Now, a key component of your expertise really comes from your venture arm.
It does.
And that is Alexandria Venture Investments. I know that your investment arm was just recognized as the #1 most active investor in healthcare startups. Congratulations to you.
Thank you very much.
Tell us where you're seeing opportunities from that venture arm, because I know that our viewers would gain great value in seeing where you see growth.
Well, it's interesting. We started this when we were private back in 1996 with the first investment we made in a cancer company up in Seattle, and we've continued it. We have about $750 million under management. And really the motivation is to accumulate leading edge knowledge, insights, and data on trends in biotech and pharma. And I think that's the strategic reason why we do it. Also a good return. And we've ventured into technology to some extent. We're a Series A investor at $1 share in Google.
Wow.
And actually still own some of that stock today.
That's fantastic.
We're an early investor in Uber and Pinterest too, who are likely to come public. So we've got a team that really is second to none, and those insights really provide us the ability to recruit and have great great quality tenants, as well as strategic insights in where the science is going today.
That is so smart, Joel. Let me ask you, because I know you spoke about this at your Investor Day back in December last year, in terms of what this expertise gives you in terms of investing and how you actually identify these growth stories. Where are you seeing growth specifically right now from that venture arm? I mean, can you identify whether it's industries? You don't have to tell us the exact companies that you're investing in, but industries that you think are the growth stories of tomorrow.
Well, I think the intersection, and this is heavily in Cambridge and San Francisco, the intersection of engineering and biology. We invested in a company that actually we're providing space for as well in Cambridge just recently called Relay Therapeutics, using biophysics, structural biology, computer design, and regular biology to create the products of the future in a way that's much more efficient than the past. We also, is kind of interesting, Maria, we gave guidance, not so much guidance, but a framework for a 5-year growth plan at our Investor Day just about a month and a half ago.
Right.
And we said to the street, we believe on assets we own today, both buildings and land, we could double the rental revenues of Alexandria by 2022 in 5 years. Kind of unheard of for a public company to say
incredible. That's true. Yeah, I heard a lot of positive things about that Investor Day in December. Okay, real quick, in terms of markets, does that play into anything that you're doing in terms of when you see the public markets as volatile as they have been? Does that give you the pause signal to wait, to take to the sidelines, or are you as active as ever?
Well, you always have to be mindful of the macro markets. Our pipeline for 2019 is already set, 2.5 million square feet, more or less, 90% leased, so we will deliver all that. And as we look out to the future, as we make commitments into 20, 21, and 22, you want to look at the macro markets and be cautious about those. But we're primed to go forward, given strong demand and limited supply. And if a tenant moves out, we have 1% vacancy in Cambridge. And rates have gone from, say, mid-70s to now mid-90s. So if we have somebody moving out at a $60 rate or a $70 rate, we're actually happy today. Kind of doesn't sound normal or logical, but we can then replace that tenant with a much higher paying rent tenant just because of the limited supply in that market. Kind of amazing.
And is it life sciences campuses that are the rage right now or something else?
Well, primarily life science, but one of our big projects we delivered last year, Facebook actually came in and took about half of a building right in the heart of Cambridge because they wanted that location, that state-of-the-art building, and they actually wanted to be away from other technology companies but closer to life science companies.
Fantastic.
So kind of interesting.
Yeah, all the technology companies are going knee-deep into healthcare. I mean, look at what Google is doing. All right, real quick, we got to jump, but as interest rates move higher, any expectation that the real estate boom slows down?
Well, it may. I think running a public company, we always want to we have very little, less than 5% variable rate debt, so our debt is set at lower rates, so we're not subject to that. But I think the key indicator, more than interest rates, is really GDP growth. If GDP growth stays on a steady path, that really is the secret.
Do you see any slowdown?
At the moment, I mean, it may slow down from a 4 to a 3 or a 2.5, but I think U.S. will continue in 2019 to outpace the rest of the world.
Joel, it's great to have you on the program.
Always a pleasure, Maria.
Good to see you.
Thank you very much. And again, Happy New Year.
Joel Marcus joining us there.